Just what you needed. Another Berkshire Hathaway take. This week's quick value was on Berkshire Hathaway. I don't know that I had any revolutionary insights that others haven't already commented on. People have talked about the balance sheet being flush, whatever. I'm going to share a couple of thoughts. So the way I structured my posts, there's an overview of the capital structure and valuation. I talked about overall operating performance, insurance performance, non-insurance performance, cash, capital allocation, and valuation using Buffett's two-prong or two-column valuation method that he's outlined. So really the takeaway, 2024 was a good year, mostly on the back of strong insurance results. The stock has run a considerable amount. I was just looking at this earlier. Price to book 1.7 times. Median 10-year multiple is 1.4, so trading a decent amount higher than historic multiple. Book value's appreciated considerably over the last few years. So, is it an attractive price? I don't know. I probably don't think so. But anyway, 1.1 trillion market cap at $508 per B share. Cash and investments, that includes equity method stuff. That includes the marketable securities, short-term treasuries, 652 billion. I included long-term debt, so you've got an enterprise value of 567 billion at the end of the day. Operating earnings, this is the non-insurance portfolio. Let me zoom this in a little. So this side of the business really hasn't grown much the last couple of years. So if you're looking at it as EV to operating earnings, you're trading at 26 times right now, excluding the insurance side of the business, which is kind of how Buffett preaches in the two-column method. The operating earnings with the insurance included is a different picture because the insurance segment has picked up nicely the last couple of years. Those markets have hardened, it's much cheaper on 2024 results. This is EV to combined operating earnings, trading at less than 13 times. If you were to include that insurance business and kind of extrapolate those results into the future, here's my sheet with kind of a breakdown of each of those chunks. So this right here is this is your non-insurance side of the business, right? This net earnings have compounded at 7% annually, 2017 to 2024. The S&P is at 9%, so that non-insurance portfolio has grown slower than the overall market. Here's your insurance business, right? So earnings were an average, what is this? An average of 5.7 billion, 2019 to 2021, then 6.5, then 15, then 22, right? So you're banking in or baking in a lot of upside performance in that segment in the last couple of years. Big piece of that is because the treasury portfolio is just ballooned, right? I mean, they're hoarding cash. So naturally, rates are higher. The cash balance is up. So they're earning more investment income just from holding on to short-term treasuries at higher interest rates, right? So put a multiple on that at your own risk. The underwriting earnings, this is also up considerably, right? This is, an average of 500 million a year from 2019 to 2022, then 5.5 billion, then 9 billion. And where'd that come from? Well, partly you've got a turnaround in the reinsurance business, and then partly the improvement in Geico, right? So Todd Combs came into the picture trying to clean that business up. Again, extrapolate at your own risk. The other businesses, hold on. Here we go. We got manufacturing, service, and retailing. We got a couple different sub-segments within that, varying CAGRs from 2018 to 2024. Berkshire Hathaway Energy, this business has grown 6% annually, and really you can see it's benefiting a ton from these renewable tax credits, especially in the last few years. So again, kind of hard to peek around the corner and see how this business is going to look out into the future. On the regulated utility side, the railroad business has been not pretty flat, actually like literally flat for what is this? This is 7 years now. So that business hasn't grown much. So again, the operating portfolio of, call it, non-insurance businesses just hasn't grown all that much. It's maybe a 4 to 7% annual earnings grower, and then the insurance business, I don't know. Buffett's 2-column approach talks about, one thing, you value the non-insurance side of the company, and then the second part, you value the investment portfolio, and that totals, what do we got? We got $652 billion as of 2024. This is cash and all investments. Just on the cash side, you can see when he sold some Apple stake in 24 that this is just really, really ballooned. So they're sitting on a ton of cash, and I think he made a comment, and I don't know, this was maybe 10 years ago, that the minimum amount of cash they needed was 20 billion. So maybe that's closer to 50 billion today. I don't know. But they're sitting on a ton of excess cash, I would have to imagine. So I think the big hangup for me, and I outlined this at the very end here, is you're trading at, call it, somewhere between 20 to 26 times operating earnings net of cash, and they've got tons and tons of excess cash. But how are they reasonably going to deploy it? I just don't see how they're going to put this balance sheet to work, because they haven't in the last few years, right? I've got free cash flow at 195 billion. This is 2017 to 2024. They spent 30 billion on acquisitions, 77 billion on buybacks, and those buybacks are now coming to a trickle. So I don't know how they're gonna deploy this thing. At some point, maybe they're going to starting to have to give it back to shareholders in the form of dividends. So this is my big hang up, is they've got a ton of excess cash, and they've been crying for years that there's not an outlet for them to spend it on. So I don't know what the catalyst is to get them to start moving. So to me, this thing has to be pretty close to fair value, but I'd love to hear some other takes on it.